Hello YouTube, it's the Cowboy. Welcome to Macro Cafe episode 7. Let's begin and take a look and see what's going on. I haven't seen you guys in a couple of weeks. We're going to be covering, as our usual stuff. We're going to go over Bitcoin a little bit here in the beginning. We're going to go over gold, oil. We're going to take a look at the dollar index. We're going to look at the S&P 500, a little bit of the relationships of the performance, some of the rotations that I see in these asset classes, a couple of interesting stuff regarding interest rates as well. So yeah, let's get started. First of all, I wanted to again thank you for subscribing and watching this channel. You can find us over on Twitter, Elliott Cafe, and then I have a couple of Telegram channels in here. There's a public channel at Elliott Cafe. There is a chat room here, public chat, and then there's a premium room as well that I'll talk a little bit back towards the end. So with that being said, let's kind of get going on our regular schedule, and a quick look at Bitcoin. Remains in an uptrend. We're actually today, last night, I think we're making new all-time highs in here. I think we just passed 60,000 in Bitcoin. This is pretty much in line with our projections towards 100,000 for this year. And, we're in the middle of still developing this larger third wave cycle, actually. And, some of these subdivisions, can be interpreted in several ways, but the best interpretation that I have for right now is that that's a 1 and 2, 1, 2, 3, 4, and then possibly we're doing another, we're finishing up this fifth wave of third, where we are actually done a wave 1, that's a 2, and then possibly a smaller third, a smaller 4, and a smaller fifth. Again, there's several other interpretations. I talk about this in detail. If you wanted to go check out my YouTube page, on there you'll see, one of the videos here is Bitcoin and Ethereum wave analysis. I've done this about a week ago. We do this every 2 weeks, and then I have several other things on there as well, along with just a bunch of kind of educational lesson about Elliott waves and all that. But yeah, if you want to kind of find out a little bit more in detail, just go back on there and take a look. But, overall, I remain bullish on this. There might be some short-term corrections. I am aware of this small divergence that I'm getting here in price, in the RSI as the price is making new highs. So, if we wanted to correct a little bit more in this fourth wave, if that's going to start fairly soon on here, I would not be surprised. But the main levels that I'm watching, it's this swing low, and then the other one that comes here next to 30,000. But again, if you want to see a little bit more, I dive more in details, go ahead and check that video. All right, let's take a look at the next slide in here, and I have US oil. And this remains in a very nice uptrend. Excuse me, this remains in a nice uptrend in here. We are challenging those 65, 64 highs from, back in the beginning of 2020 last year. I talked about this a couple of weeks ago that those levels are likely going to get challenged, and there'll be a little bit of a resistance as we're approaching those those important kind of swing levels. Oil remains in a very good bullish uptrend. And it's kind of tied up with the reopening of the economy. You can talk inflation, trade reflation, whatever, but, people are going to start, obviously, using this commodity a lot more than they've used before, and it's already reflected in price. I am expecting these levels to hold a little bit and not give up that easily. You can see that we're getting a little bit of a pullback on there. I'm going to be watching this 59 as a first level, then 51 on the way to the downside. There is a major trend line, right, coming since 2007, 2008, when oil actually hit those 150 levels. And since then, we've been actually correcting lower. I mean, we came negative last year, and now we're kind of back in the middle of that range. This trend line here will probably offer a little bit of a resistance as well if we're able to manage to get all the way up there. But the next level of significant importance is this kind of X wave Y at about 76, right? So anywhere between 65 and 75 with the trend line, it's a fair game for heavy resistance. This could be counted in 3 waves at this point, just a simple A, B, and then up in C, right? And then followed by a possible correction lower. We don't know exactly what shape it's going to take and what's going to happen after that takes place, but this will be the more conservative approach into the prices of oil. The other one that's more impulsive, more bullish, would be that this is actually a wave 1, and then this is a wave 2, followed by the next advanced higher, which can take us back to $140 oil in possibly, who knows, maybe into I would not expect those targets to get hit. I think just by kind of looking at these charts, it would kind of have to be massive, just a huge rise into the price of oil to get all the way up there towards the end of the year for that to happen. So possibly more conservative, it's that these targets might get hit, let's say, in 2022. So going from a 1 week here to a 1 day chart, you can see a little bit better these levels of resistance. Oil, it is pulling back slightly. I'm expecting support at 59, and then if he wants to sell a little bit lower above, right here at 51. But overall, some kind of near-term targets, if we continue to push higher, is 61.8 multiple of wave A, distance traveled in this wave C. This continues to look like a very nice and impulsive move. There are no major corrections just yet. There is no point in actually counting this at this moment. Just kind of let it develop. Watch some of these swing lows. When we're starting to get a little bit of a major correction, something that's slightly larger, right, then I can start to identify, if this is going to be a wave 1 of these lows, or we'll actually have to move this wave C back here. That all depends on how we correct from these levels. If we're starting to sell off impulsively, we'll secure a wave C. If it's a corrective move, we'll probably secure a wave 1. But overall, if you look at the energy markets, if you look at the XLE, everything it's pushing higher, and there's just a shift from all the technology stocks back to energy, and I think this is obviously reflected here as well. All right, just quick before I finish with the oil, I don't want to spend too much time, but I wanted to show you just the moving averages where we are. So this is a 1 day chart in here. You can see that we're in a clear, nice uptrend, 20-day, 50-day, and 200-day. Price is supported. It's been offering support on the way up. So on a shorter time frame durations, this 20-day will continue to provide support in here, and it's a good indicator of this shorter term uptrend, followed by the 50. And kind of watch those in conjunction with some of the levels and the fib pullbacks, and it can offer some good opportunities on there. On this is the weekly that I have on here, and we're pretty well above the 200 week moving average, which is right now at about 51. So this is a very important breakout, but this is kind of where the markets consider, right, more of a return to the mean, and some kind of an average fair price for oil. So if he wants to come back, you can see there's a confluence in here of support. You have the 200-day, you have the 200-week, you have the 20-week moving average as well. So if the markets kind of pull back, that kind of coincides with this would be a good level of support, and possibly create some kind of a right shoulder up into these levels. And if these hold really well, then we're going to look for new highs. So that's on oil. Exciting. Let's take a look at next. So gold, it's been very underperforming the other markets on here, and as much as people talk about inflation and about the balance sheet of the Federal Reserve and $27 trillion in debt in the United States and all these huge numbers, gold is not responding. And one of the reasons that is because gold is tied to, it has an inverse relationship with the real yields, and as long as those starts to creep up and rise higher, gold is going to suffer. Gold does not like a rising yield environment, and you can see that reflected into the price. Now I'll get in a second here at the 10-year yields, but they're approaching some important resistance levels. And if that kind of coincides with the low in gold, it's going to be interesting to watch, because we have some multiple signals coming here that gold could be bouncing. I'll take a look at the moving average. We have broken below some of those very important ones, and that's a bearish signal. But in terms of an Elliott wave structure, Elliott wave count, I like what I see. I see, a nice trending channel in here. I see that we're attacking the bottom of that channel. I like this move to be counted as impulsive. This is the largest correction in this overall sequence ever since we started middle of 2018 lows, right? This is the largest correction. It almost matches at 100% duration in time with the second wave. It matches in size as well, pretty much, right? And it looks like a nice corrective pullback. It is contained between parallel lines in here. We're approaching 38%, which is a very nice, almost textbook pullback for a fourth wave in here. We broke actually below the trend line, but we pushed back up inside this channel. If you go on a smaller time frames, maybe a 4-hour, a 2-hour chart, you'll see that there's a little bit of a divergence in there as prices kind of start to creep back up. But I am watching for more of a confirmation, this 1813. level, which I think it's the top of this B wave. If this is a W, X, Y, X, Z, you have a B wave, a triangle B wave up into these levels, and I'm watching this 1813 to be taken out before I get more confidence that a low has been found in gold. But things start to look interesting, and gold kind of, even with the rise in yields that happened on Friday and Thursday, gold failed to decline, and that's a good sign for a possible return to a bullish outlook in here. The RSI continues to look bearish in here on this 1 week, but we are at low levels, and this sometimes coincides with the low in gold. I mean, you can see back in here as well, where the RSI was, just kind of back into almost into the oversold territory, and then a similar story happens right now. So I'm starting to get evidence in here that gold could be bouncing. Let's take a look at the smaller time frame here on a 2-day chart. The picture doesn't change a whole lot, but you can see a little bit better the subdivisions. You can see these levels, right? You can see how the RSI is kind of turning up a little bit in here, and you can clearly see how this move from these 2100 highs in gold, it's kind of clearly corrected, right? It's coming into a lot of overlapping structures, and this tells me that this move is against the overall trend. Moves against the overall trend are corrective, and they usually tell you that the markets are going to make new high. So very interesting what's going to happen in yields if gold starts to push back up higher. Taking a look at the moving averages as well, this is the daily chart. We have broken clearly below the 200-day moving averages. That's a pretty big bearish signal. We've broken below the 21. That kind of will hold. Any pullbacks to this would probably be sold into, for the shorter term momentum traders. They're going to try to take this market even lower. Then they're going to use 50 if there's their defense, and then the 200. So that's why I want this market to kind of start to take some of these levels before I get more excited about gold, right? There is plenty of time. The market will probably push back up higher in there. It'll take a couple of weeks, maybe a month for that to happen. If it does, then we're going to do a pullback in here that's going to give us a chance to say, yeah, this huge correction is over, and now we're about to embark in the next trend. So I'm not rushing to pick a low in gold. I'm not smart enough to know when that is, but the market will tell us, right? The market will start to give us those signs, and it's that easy, right? There's no point. Nobody's going to build us a statue if we call the low in gold. Back on the weekly moving averages here, you can see that the 200 week, it's pretty far. We're at about 1460 on that. So if that's probably going to be major support if that happens. You can see you also have a swing low from I think back in spring of 2020, right? And if gold decides to move a little bit lower there, that would be the next kind of major support. The fact that we've broken the 50-week moving average, which is a very important one in the longer uptrend, is a little bit concerning. So that's why we need to wait for this market to get above it. All right, so that's kind of my outlook on gold. All right, let's take a look and see how the yields are doing. So you can see, right, ever since you found the low in yields, and as they're moving up higher, gold has been selling off. All right, if you kind of subtract the inflation rate from these, you find out the real yields as well, and those have been creeping up. What's interesting in here is that we're starting to approach very important levels. I mean, you can hear, right, in the mainstream media, on other blogs and channels and stuff like that, everybody talks about the 10-year yields that's been rising pretty fast. What's this going to do to the markets? If it's going to create, havoc in there, and the S&P 500 will sell off, and these put pressure on the economy. I think it's very, very premature. 10-year yields are only at $1.60. Now, yeah, the rate of change has been pretty fast. You've had a pretty fast rise in yields, but it doesn't mean anything. You can start to move sideways here for a while. The market will digest it, and you're going to get back to let's say when was this? I think it was in 2020 before we crashed, or in 2019. They were at 3%, and the markets were pretty nice and bullish. So 160, it's a little aggressive, but it's nothing of major significance. Yeah, the stock market, the tech market reacted a little bit, and you could see sell-offs in some of those kind of higher growth names. But for right now, there is a rotation, and the market continues to look bullish, and Federal Reserve stepping in and trying to cap yields. I think that's a story that's, a little bit overblown, and there might be a while until that happens. I think, it's probably going to take us to get all the way up here to 325 before, the Fed is even going to think about doing anything to the yield curve. So, overall, these remain bullish. Now, in terms of, Elliott wave structure or more of a technical pattern in here, you can see that wave C in yields is almost equal with wave A. So this first advance that we've had from those March lows, it's now equal with this advance from this pullback in the wave B. If this is an ABC, fine, we're going to push back lower. If this is a second wave, that means that this is just the beginning of a larger third wave advance. And the next level that's going to offer very serious resistance is 195. I think that's where the market is going to travel. It's going to try to challenge these levels and see what happens. It's going to test the Federal Reserve. It's going to test the markets, see what the response is, see what the S&P 500 does as well. If you can take a look here on this chart, right, this is a weekly moving averages chart. You can see that the 200-week moving averages comes at about 195. It's been a pretty good indicator of what happens to yields and as a level of support and resistance. If you pull a larger chart, this one it's just kind of smaller, goes back to 2015, but if you look back all the way to 2000, you'll see that the 200-week moving averages, that kind of provides that support and resistance as the prices bounce up against it, or as they're selling off, they're kind of rest on it. So that kind of coincides with this 195 level that I have on here, right? So I think the markets are going to try to test those levels, and then we'll probably take a break, maybe sell off or come back towards 137, 140. By that time, these moving averages on the daily will start to rise up. They're nicely supporting the price as well. You can see the 200-day right now, it's a 0.86. That's going to be a major support on the way down, along with the swing high. And listen, try to incorporate the 10-year yields into your analysis of the markets. I think this is a very important indicator of what happens overall, at what bond market thinks about inflation. And this kind of spreads. It spreads into crypto, it spreads into all asset classes, and it's a very kind of important thing to watch, and just kind of adjust your thinking of that. I'm going to take you to the yield curve as well. So this is 10s minus 2s. So 10-year notes minus 10-year yields minus 2-year yields in here. You can see the periods of recessions in here. You can see that we have, that aggressive rising yield curve in here, which helps the financials a lot. Let me take you to, this is a similar chart. It's just kind of shown a little bit different. It shows the periods of recessions as well in here. So you can see how the yield curve inversion kind of always precedes those recessions, right? It happened in here. It happened before the 2001 recession in here, right before the 2008 crisis. We barely dip into negative territory, right? Just in 2019. And then, we had the virus hit and we've got into a recession. Now, this recession that happened since, let's say January or February of last year, it's one of the shortest recession in the U.S. history here. I think it's just 2 quarters. I'll show you here in a second. But the rising yield, the rising yield curve here shows you that we're in a period of recovery, and there's still a lot more room to go before we can let's say reach some kind of super elevated levels. I mean, you can see in here you got to get pretty much all the way back here to about 2.6. So there's plenty of room to run onto the yield curve as well. Let's take a look at this from the Fed data. You can see here the U.S. recessions, 70, 75, 80. There was a double recession in here. Then you have in the 90s, 2000s, 2008, and then a very short-lived one. That was just 2 quarters, right? Because that's how they identify recessions. You have to have 2 consecutive quarters of negative growth, and that was back in the first quarter in here, -5 GDP, and then -31, and then you had this big bounce back. Now we're just kind of still very sluggish, but everybody kind of expects this to increase and to get back to high elevated levels, and then we'll see what happens from there. But for right now, this is where we are in terms of GDP and the inverted yield curve and the relationship to the other markets. All right, let's take a look at the S&P 500. You can see, I mean, if you check back a couple of weeks ago, we were a little bit negative because the markets were selling off, but these 37 these 3,700 levels into the S&P 500, they continue. They held really well. The market never broke below that swing low, and then we're basically pushing back up higher, and we're challenging to make new highs. I don't have a high degree of confidence that this is a fifth wave. It's kind of what I'm posting here because of the 100% relationship with this wave one. I don't have the full chart on here, but that's where this would travel 100% with this wave one on here. So you can see that the market offers pretty good resistance there. But the alternate count is that this is actually the top of the wave one. That's actually two, and you're actually beginning a much larger bullish cycle into the equity markets. And you can see, everywhere that there is a big rotation from growth to value. And I think 80% or 85% of the stocks in the S&P 500 are above the 200-day moving average, and that's pretty bullish sign. And these markets kind of rotate, and people are excited about reopening, and I don't see why the markets would sell off. Now I could always be surprised by it, but I'm not going to tell the market what to do. We'll wait for some of these key levels to get taken out before we before we even care about it. So for right now, I have exposure to stocks. I remain bullish on it, and I'm trying to look at all this, other macro indicators to keep me on the right side of the market. And for right now, that's from the lower left to the upper right, which is bullish. Let me take you and show you a little bit on the moving averages as well, right? I mean, it doesn't get any cleaner than that when you have, a 200-week moving averages that continues to support prices, right? A little bit of a flush here. On the sell-off in March, but we did this V recovery, and now we're pushing back. The 21-day, the 50-day, they're all pointing higher. The trend continues. This is the daily charts. We broke below this 50, and we pulled back up higher. The market doesn't want to sell off just yet. You might have some divergences in there. I am aware of all of that. People argue like, hey, how can the market actually rally without the tech sector, being part of it and supporting the rise. But listen, there's plenty of other stocks that are doing really well, and possibly the tech sector will take a break for a while, or maybe they even join into the party a little bit later after they correct. So for right now, this is up into the right, and I'm going to be watching shorter term. The 200-day moving average is about 35, so that would be the next major support if we're going to come back down. All right, but for right now, we remain pretty bullish on these developments. Similar story on the daily charts, right? What if this whole thing is just a second wave and not a 4, as I have in here? It's the largest correction so far in the sequence, and we're not getting a pullback. I'm telling you about the little divergence between price and the RSI. So I'm a little bit aware of that, but I wanted to stay on the right side of the market, and the highs are getting challenged again. So I kind of moved this fifth wave from these lows a little bit higher. If this is going to be, maybe this third wave is still in progress and continues to move before we actually reach a high on here, right? So again, I'm not telling the market what to do. We'll continue to watch. As long as you make higher highs and higher lows, that's a bull trend. All right, let's take a look here at the dollar index next. And you can see this is kind of going back to 1972, and it's been in a structural downtrend ever since we've kind of hit these highs, back in 84, 85, right? The dollar index has been declining, so dollar has been losing purchasing power. You can see, people say there's no inflation, but depending on where you look and for who, right? But we've been coming lower, and we've been making lower highs here, not necessarily lower lows until we start to take these back here. But we've been in a pretty massive range since 2015. Right? We're pretty much in a box. We're going nowhere. Right? We're bouncing between these two levels. People talk, hey, the dollar is bullish, dollar is bearish, this and that. But overall, if you look at this larger time frame, we haven't really done much. So they are important. We're very, very close to breaking some key levels in here. So I think if these get taken out, right, there's a chance that we're actually going to begin a larger downtrend into the dollar. But until that happens, we kind of have to respect them and say, listen, there could be a bounce in here. A similar story for the upside. You're looking at that, 102, 103, close to 105, I think, for these levels. And, we're not going to get super bullish the dollar until those levels get taken out. And the emerging markets look pretty good, right? The reopening of the economy. I have some slides that I show into our program in there where we look at the emerging markets and the dollar and all that. But, those are kind of inversely correlated. Back below here, you see the dollar index. I mean, the euro dollar. right? A complete inverse relationship with the dollar index, just because it's got such a big, holding into the dollar index. But, similar story in the euro. Euro really hasn't done much, since 2015. We're still in this kind of crazy range on here. So if the dollar is falling, these levels, the 125, they need to be taken out. And, then maybe we will begin a new advance here in the euro. This move up here is clearly impulsive. So if I'm just counting from these lows up to here, right, this looks like a full corrective pattern all the way up into these lows. That's a wave 1 impulsive. That's a wave 2. So now we're starting to build wave 1 of a larger decline. So I'm really curious to see if we're going to get another 1 and another 2 here, retest the breakout, and then continue to push higher. Right, so keep an eye on euro, keep an eye on the dollar index. It's super interesting. Just on a smaller time frame in here, this is I think more of a daily kind of outlook, going back to 2008, and that's the decline from those 102.99 highs. I'm considering that a B wave or a wave 2. Right, so if we're beginning a larger decline, that's going to be a 1, because that's clearly impulsive. This looks more of a corrective pattern. So it's either an A wave or a wave 1, followed by a second wave or a wave B. If it's a C wave, then we're expecting a much larger advance into the dollar index, but it needs to start impulsively. For right now, all I'm getting from these lows to these highs is just a 3-wave setback, and tells me that's corrective. That's against the trend. That means we're going to try to make new lows. And I'm looking for this 1, 2, 3, 4, and another wave 5 before we maybe correct again in 3 waves here in the dollar and then start the decline. So it's very important to happen up into these levels. If we're going to push up higher here impulsively, if we're going to take that 94.29, then and only then I'm going to start to say we might have a completed sequence here, either in wave C or in a wave 1, and now I'm looking to see how this develops before I get a different sense for the dollar. All right, let's take a look now at some of the small rotations between these asset classes that I was just talking about. So what we have in here is we have, we have an improving quadrant, we have the leading, the weakening, and the lagging. And this work is done by Julius de Campenaar. You can find him on Stock Charts, you can find him on YouTube, and he's the creator of this. And it basically tells you how the markets rotate against a benchmark. And the benchmark in here, I think it's the Vanguard Balanced Index. And markets kind of go in and out of favor, considering that benchmark here at the center, right? I mean, you can see Bitcoin, it's been, bar none, the best performing class here for, I don't even know, I mean, this is a monthly, I'm not sure even how far it goes back, but 1, 2, 3, 4, 5, 6, 7, and it's probably even more than that, right? That's been eating lunch from oil, from the dollar index, from bonds, from gold, from the equities. Doesn't matter what you look at. Bitcoin is so far up into the right that it's unbelievable. So, if you haven't owned anything like this but Bitcoin, you've done probably super, super well. And crypto field remains a very exciting field with a lot of interesting developments. And these are monthly rotations. These take a long time to kind of resolve themselves. You can see oil in here. It's coming back into the improving quadrant. So basically we're rotating among these quadrants in here. So oil continues to look pretty good. At some point here we'll get into the leading and will outperform that balanced index on there. Dollar index is heading lower. Bonds are heading lower. Gold is heading lower for right now on the monthly charts. And the stocks are looking good. Now, you don't have a lot of momentum going on them. Maybe this red arrow will start to build and create more of a larger push. The moment the S&P 500 will get more aggressive to the upside. But for right now, it's a kind of a steady grind higher, right? So if you want performance, Bitcoin is the place. If you want safety, you've got the stocks as safe as they could be, and you're going to lose money in bonds and so far in gold, right? And oil continues to look good, and it's also it's got pretty good momentum in here. Relative strength, Bitcoin continues to outperform. And let's take a look at the next one. This is the weekly rotations in here. So this is kind of going back 1, 2, 3, 4, 5, 6, about 7 weeks. Also, Bitcoin has been losing a little bit with this correction that we have in this fourth wave. But it's still in this leading quadrant, right? So trend is up, relative strength is good. We're just losing a little bit of a momentum, and at any time this thing can turn back and continue to push higher. oil, it's the second place on here. It's just a nice uptrend, just like you saw on the charts, right? The arrow, it's not up, it's not down, it's kind of flat and sideways, which means it's trending. It looks great. Dollar index have been gaining a little bit of room here, but it's very small. And then the S&P 500 here, it's just back here towards the middle. All right, let's take a look at the performance here since the beginning of March. So this is the performance of all these asset classes that I talked about over the past 2 weeks. So I think my video was a couple of weeks ago. So Bitcoin here, it's the best, right, at about 20% for the month of March. And it looks pretty good and pointing higher, especially with today's breakout. Then you have crude oil futures, up 8%. You have the S&P 500 that's beating the dollar index just barely. And then gold is actually negative, right? Not too much because it's been declining, but they're not a very aggressive rate in here. And then bonds, oh boy, they're hurting with the 10-year yields continuing to rise. So, all right, we've come to the end. So thanks again for watching and subscribing to my channel. If you're new here, please hit subscribe and maybe the notification bell. Give a like so more people can see this content and take a look and see kind of how we look at the macro aspects overall. Don't forget to check out my other videos, again, with Bitcoin and Ethereum technical analysis. There is a bunch of educational stuff as well. Come and give us a try into the Elliott Wave Cafe. Now there is a 7-day free trial. There's no card. I used to charge for trial. I don't anymore. Come and see if you like it. Take a test drive and see how you like the room and what we're presenting out there. There's daily videos, covering a bunch of markets. There's a chat room. There's a chart channel with updates, and there's stocks in there. I take trades, I present everything. There is an alert room for all the trades that I'm taking as well. So, we talk about preparation, about how we manage all these trades. There is a chat room when people ask me questions and they can interact directly with how I think about the markets. And, come and give us a try. You can, kind of take this. There's a link below this video, but you can also type this into your browser. Again, thanks again for watching and being a part of Elliott Wave Cafe and coming back to check out the content. So thanks again, and I'll see you in a couple of weeks. Bye.